what new highs we can have when it comes to equity markets next year.
Well, good morning and Merry Christmas. I think it's time to dust off the old adage, which is respect the trend, but don't ignore the risks as we go into 2026. Respecting the trend appreciates the fact that we're still very much in an uptrend in this market, and it's also being led by pro-cyclical areas. You mentioned industrial commodities. Earlier, you also have leadership in things like banks as well as transport starting to turn higher. So there's a pro-cyclical message coming out of this market. And you also have a very important uptrend in earnings estimates and GDP estimates. And this has been the key fundamental underpinning as to why we keep being able to press to new highs. As long as you're revising estimates higher, that's usually a good environment for risk taking. So the second half of that is don't ignore the risks. And that's where we look at things like valuations. We look at signs of things like complacency within markets, look at the VIX turning ever lower each and every day. And so it could be in an environment where we're still able to carve out new highs because of those earnings estimates, but there could be some volatility and chop along the way simply because you have a high bar with valuations and a high bar with expectations as well.
But you still think positioning is not yet stretched. What would get us to that point?
Our favorite measure is looking at the Deutsche Bank consolidated equity positioning, and this is really measuring institutional positioning. And what's fascinating there is that we're in the 62nd percentile, which is just about slightly overweight. But if you look at discretionary investors, they're still just neutral. And so we think that there's still room for more people to get dragged into this market. But if we're talking about positioning, we also have to mention households as well. And that's where you cannot make the argument that people are underweight equities. You can look at the AAII survey that looks at equity positioning. That's at the highest level it's been since peaks like 2018 and 2022. We've talked a lot about how margin loans have grown extraordinarily over the last 6 months at about a 40% clip. So there are certainly signs that households are very fully invested, but some institutional investors have still sat on the sidelines, which just is likely why over the last 6 months or so, every dip has gotten bought so rather quickly.
Yeah, talk a little bit more about that money that's sitting on the sidelines, the dry powder, if you will. We've talked a lot in the past about money market funds and how there's more than $7 trillion of money just sitting there waiting to be deployed. Maybe retail investors are fully invested, but that doesn't take away from the fact that there's always that possibility they could put more into the market. How are you thinking about what it would take to get that money to be put to work?
Yeah, we've never considered the money market funds as exactly fungible funds that could go into equities, meaning that these were savings and cash balances that were typically held in cash savings accounts versus just things that were anxious and waiting to go into equities. So maybe at the margin, as you see those money market funds start to fall, it does incentivize people to look for other investments, but it's not necessarily a direct line straight into the equity market. So certainly, money market rates falling could push investors into looking into other areas instead of just sitting on the sidelines and clipping coupons, but not necessarily $7 trillion of a wall of money that will go into equities.
So the Santa rally that we have right now, how much of it is driven by technical factors like positioning versus true fundamentals, earnings growth, and the earnings outlook for 2026?
Yeah, this time of year, we try not to read too much into the price action given volumes being so very light. And we do know that there tends to be some kind of window dressing and positioning chases into year end. And what's really fascinating is that we saw the rotation in leadership start a little early this year. Typically, we see leadership rotations where you have your classic dogs of the Dow or the last shall be first trade that kicks off in January as people start to rebalance portfolios in a new tax year. But it seemed to start in November this year, where we saw value, for example, outperform growth by 5% since November 1st. So maybe people are trying to get a little bit ahead of that. But at the end of the day, we try not to read too much into very end of year kind of price action, simply because it doesn't reflect anything more than likely just positioning chasing.
Cameron, when it comes to the commodity space, if you look at what happened this year across the entire spectrum, gold, silver, platinum, copper, do you look at that and you think you have to maintain part of this into 2026, or do you think individuals should make sure that commodities are part of their portfolio?
Yeah, we see commodities as a way to have an inflation hedge within portfolios, and they work really well when they work well, and they don't work so well a good portion of the time. So certainly we've been in an environment where that has been a very powerful uptrend for a lot of these commodities. I think the question is, how much can it continue? Jeff DeGraff of Renaissance Macro put out a great piece effectively saying, hey, when you've doubled your return in less than 2 years, the probability of you doing it again is extraordinarily low. So it gets back to this kind of overall notion of respecting uptrends and not ignoring risks. Gold is in a very powerful uptrend. We've been calling it the Chuck Norris of commodities. Nothing seems to be able to keep it down. It doesn't even touch its 50-day moving average. But if you look at longer term charts, it is extraordinarily overbought. So it wouldn't be surprising to see some kind of consolidation. But we do know that there still remains very powerful drivers of, for example, central bank buying of gold, but also appreciate it has become somewhat memeified, meaning that it has become effectively a momentum stock. You're seeing a lot of trading and retail investors, as well as investors overseas. So it could get a little bit over its skis and consolidate, but the uptrend is still very much there.